Right now, it's time to bring back in my good friend and co-host, Jeff Small, as well as a good friend of the income generation, Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report, available on gloomboomdoom.com. Dr. Faber, thanks for being back with us today.
It's my pleasure. Thank you very much.
You know, I have so much to talk to you about. You were here back with us 4 months ago, literally at the bottom of the stock market, literally at the very possibly the worst day. So we want to talk to you a lot today about first the economy, then the stock market, and then the Fed. And we want to see what's changed since last time. So first, the economy. We're about to get some economic numbers out over the next several weeks between corporate America, between second quarter GDP shrinkage and everything. You thought they were going to be pretty gloom back then, but how do you think they're looking now after living through this partial reopening? Do you think that they're going to be a little better than maybe you initially thought, or even worse?
No, I think the real economy is the figures are going to be bad, but they're going to be good compared to what they were, say, 6 weeks ago or 2 months ago. You understand? We fell off a cliff. And like a tennis ball, we're rebounding. We're in this rebound, but it's still going to be lower than a year ago. And in some industries, much lower than a year ago. Say airline traffic may rebound by 100% from the low, but then it's still down 70% from a year ago. So these are the kind of figures you can anticipate.
Yeah. Well, I know one of the things you said, too, is that the economy was already starting to turn 18 months before this crisis. So this just expedited it. What's your best guess? I mean, if you've been on the show several times here, so allow me to just push you just a little bit. If you had to guess what the number would be for a percentage GDP drop in the second quarter, is it going to be like the minus 35 or 40% that Morgan Stanley, Goldman Sachs predicted? Well, what if you had to pick a number? What's your best guess second quarter?
It will be lower than a year ago. Exactly what it will be will depend on who publishes the statistics. You understand? It's like the votes. It depends who counts them. And one thing that has happened that wasn't the case when the stock market hit the low on March 23 was that we have had huge stimulus packages. And this stimulus has kept incomes at a relatively high level. So exactly what the figures will look like, I think to make a guess, I suppose GDP will be down 15 to 20% maximum, what they will report. But you have to understand, people don't eat by GDP. We had this huge stimulus. We had also huge liquidity injections, and the liquidity injections have been very good for Jeff Bezos and the Netflix and the Apples and the Zoom of this world, but they haven't been good for the mom and pop shops. They've been very good for the Robinhood trading platform and for speculation in stocks, not just in the US, globally. There's a huge mania in stock buying and selling, day trading.
I know, and it's interesting. So you actually think in pure GDP, it's not going to affect a lot of America, but pure GDP second quarter, when it finally comes out next month, the report won't be quite as bad as Morgan Stanley and Goldman Sachs had predicted.
Yes, I don't think it will be that bad.
But I want to turn it over to Jeff to ask you about how that affects the stock market, because I know Jeff's chomping at the bit to talk to you about the market. Jeff?
Yeah, Dr. Faber, I was listening to one of the Federal Reserve bankers yesterday on CNBC, and I won't mention him by name, but he said something really alarming to me. He said he doesn't see the economy converging into stock market values for years. And that gives me the idea that they're going to have stimulus upon stimulus upon stimulus. And as we reach these new epic values in the market, it seems completely disconnected. I mean, do you see a time when the economy may converge into stock market values? Because right now they're disconnected.
And Dr. Faber, just so you know, we only have 1 minute left in this segment, so go ahead.
Yes. Okay. The Fed monetizes debt. They also bought junk bonds. So the stock market has rebounded very strongly. And I think the stock market may continue to go up because of money printing. In other words, not for the right reason. It's no longer an economy where the real economy, what you and I do every day, has an influence on the stock market. It's a stock market that has an influence on business. And this is the essentially situation we're in.
Okay. All right. Interesting. Well, we need to take a commercial break, and when we come back, I want to talk to you more about the stock market and want to talk to you about the Fed. So if you stay with us, Dr. Faber, that'd be great. And you stay with us too. We have much more to come here on the income generation in just a moment. We'll be right back. Now let's bring back my co-host, Jeff Small, along with Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report, available on gloomboomdoom.com. So, Dr. Faber, I know you're trying to be good there before in answering Jeff's question and trying to do it in time because we had to take a commercial break. But I have a feeling there was a little more you wanted to say there. Am I correct?
Yes, especially Jeff asked or made the comment that, in his opinion, the diverging performance of the real economy and the stock market would mean that there would be continuous stimulus packages into the future. When the Fed first began with QE1 in December 2008, my view would be that there would be QE infinity forever. Once you start printing money, it's very difficult to stop it. And secondly, once you start with handing out money, as was done, and at the same time, many states are still essentially under lockdown, what will happen is that paradoxically, under a Republican president, they introduced basic income. I think the basic income will continue because at the present time, and this is very dangerous in my opinion, there are so many academics that claim that debts don't matter. Debts don't matter now because interest rates are next to zero. But if one day interest rates go up, it could end up in a gigantic mess.
Yeah. I know you said that last time, too, that you were concerned about that. What's interesting, the changes, I think we might have interviewed you literally one day before the Fed came out with the big package. They lowered Fed funds rates to zero. So you were thinking the market was going to be down 50, maybe even 70%. And then obviously, literally a day or two later, I think the Fed tried to make a liar out of you. But Jeff, I know you wanted to ask more about the stock market, too. So go ahead.
Yeah, I guess, Dr. Faber, the valuations and are really ridiculous. You mentioned Facebook, Amazon, Netflix. They all got a big boost. And so now we're at this new market plateau. We're 4% below the market peak we were on February 7th before the virus really took hold of the markets and put the fear of panic selling in the markets. And so at this point, though, when we look at things like the Buffett indicator, which is a simple ratio of the market cap as a ratio to GDP, it's going to be in the 190th percentile. That's the biggest it's ever been. I mean, this market value is really scaring me. Do you see a correction coming because of these values being too high at this time?
Well, first of all, I have to correct one point. On March 17th, I sent out a tweet that the stock market was grossly oversold and that it would rally. So it's not that I said that near the market lows it would fall another 70%. But basically, on valuations, traditional valuation measures, it should probably be down very substantially. However, we have to be more nuanced. The stock market is driven by very few stocks. So if you look at the list of new highs, it's very narrow. There's just, say 20 stocks that are driving the indices higher. The semiconductor stocks, the FANG and related stocks, Tesla and so forth, they go into the sky. But then you have many markets, also especially foreign markets, that are depressed. They've been in bear markets since 2015. So this is where the value emerges, in my opinion, and where the markets, what you could have is essentially the FANG stocks coming down or no longer going up, and value stocks, including oil and resources and gold and banks going up. So this is a possibility. The one thing I believe is that the Fed, and that I said a long time ago already, that the Fed will not tolerate a 20% decline in asset prices. They will support asset prices because they're already so deep in ST. So they can't give up. Number two, what you said about the packages, I think, as you know, there is a bickering between the Democrats and the Republicans and so forth. And the Democrats want to essentially prevent Trump from winning a second term. But it is inevitable that they will have more stimulus packages. You can't stop giving out money on July 31st. Otherwise, the whole economy collapses overnight.
Well, no, you're right. I mean, even Nancy Pelosi said they want to reconvene Congress in August so they can work on another round of financing and stimulus from Congress. And so obviously it looks like it's going to happen again. You're right.
You're right. You got basically the basic income that came in from Congress, and then you have the Federal Reserve with QE affinity. So 30 seconds left, Dr. Faber. Our average income generation member over the age of 55 years old, what do they need to know? What do you want to tell them?
I think the biggest danger is that the current expansionary monetary and fiscal policies lead down the road to hyperinflation and the complete implosion in the value of paper money.
Well, I hate to leave it on that note, even though we have to. Perhaps we could talk a little bit about how to protect against that in the next segment, Jeff and myself. Dr. Faber, thanks so much for being with us today, as usual.
Well, thank you very much for having me.
And
Bye-bye.
you stay with us, too. We'll be back here with more. Jeff Small and David Scranton right here on the Income Generation. We'll be right back.